Hi, Chris here, talking about option trading before earnings. So if we go back looking at Google symbol GOOG, we go back to their last earnings announcement. It was on April 12th, right after the bell it's looking like. Now, just so I can show you a fair estimate of this, the price was about $650 that day. So April 650, let's go back to the last time it was about that price when it closed, and it takes us to about March 29th. So first thing I want to talk about is that I have my option chain right here, and we're actually looking at the option chain from April 12th. So Thinkorswim gives me a little history. So I want to show you a specific column that is called the implied volatility. So you see right here IMPL-VOL, this is the call side, and then implied volatility on this side. And it shows as a percentage. So I'm going to take this back to March 29th just to show you a normal state per se. So what this does, the implied volatility measures the relative cheapness or expensiveness of an option. So if implied volatility is high relative to the past, that might mean that an option is overvalued, and if implied volatility is low relative to the past, that might mean it's undervalued, and you could get an edge by either buying it or selling it versus simply trading the underlying. So let's actually take a look at this right now just to measure the relative cheapness or expensiveness of an option. So I'm taking a look at Google, and this is for March 29th, which was about a week and a half before the actual earnings announcement, and we basically see that the implied volatility for most of these is sitting around like the 34, 35 level. Okay, so we were at about $650, so now let's go a week and a half forward and go to the day of earnings, right before earnings. So that would be the 12th. Now look at this. Implied volatility for the near the money options sitting around like 53, 54, 51%. Okay, so first thing I should do is send up a red flag saying, wow, options are expensive before earnings, even though the price was the exact same for the stock price. Suddenly options are super expensive now. Okay, so let's actually quantify this. I'm going to go back to, so let's just take a look at this first. So we're at, let's just say 53% here, and a week and a half before we are at, let's just say 35%. So the implied volatility is 18% higher the day before earnings than it was a week and a half ago. So let's actually take a look at this. If we just take the April 650 option and we're going to make it, we're going to adjust the parameters and we're going to add 18% to the implied volatility and see what it does to the actual option price. So the price on this date at the end of the day, so March 29th, it was between the bid and the ask, so about $21.90. So now I'm going to take a theoretical price calculator, and you see we have this theoretical price column in the side here. Keep an eye on the 650 right here. And I added 18% volatility to that option. So now, whereas at 34% implied volatility, the option price was $21.90, now if we add it so it's the same as it was before earnings, it's now $33.58. So just that mental demand before earnings for options, calls, and puts, just because of that, it has the power to drive the price of an option up over 50%. Nothing, it's the same exact product. There was time decay. It's the same exact product. It's just that the crowd demand drove the price up that much. And that happens almost always at very publicized earnings like Google and Apple and IBM and all those big companies that might have a large swing. All right, so keep looking at the article to see how you can not get ripped off by buying an overpriced option before earnings.